Hi, I'm Pattu from freefincal. Today, let's take a look at HDFC Top 100 Fund and ask if existing investors should exit or hold on. Now, people who have been investing in mutual funds since the early 2010s or before that definitely would have heard of HDFC Top 100 or Top 200, HDFC Equity, HDFC Prudence, the mutual funds managed by the great Prashant Jain. But people who have the young earners who have started investing just in the last few years from 2016, 17, 18, they probably would not have appreciated the aura of Prashant Jain, or they would have probably not put in too much money in these funds because things have changed things change quite fast in this space, and he is no longer the star fund manager that he once was, and that's there can be no arguments about it. So this video is primarily for existing investors in this fund. I don't think any new investor is likely to consider HDFC Top 100 Fund seriously for obvious reasons. It's a 2-star rated fund. It's not bet the index for several years and so on. So this is only for the benefit of existing investors. Now, HDFC Equity, HDFC Top 100, these funds have a very interesting history. Now, I had talked about HDFC Equity in a separate video. The top 200 funds started out as ITC Threadneedle Top 200 in 1996. It was acquired by Zurich and it became Zurich India Top 200 Fund in 1999. Prashant Jain took over the fund in 2001 when it was with the Zurich India, and then he moved over to HDFC when HDFC acquired it in 2003, and he has been the fund manager since 2001 onwards. The fund has initially, or I should say at least before the 2008 crash, I had studied this fund before, and I looked at the fact sheets at that point. I think I did it in 2011 or 12. Before the 2008 crash, the fund had freedom to invest in across market caps, more or less. It was benchmarks to the BSE 200, but it had that flexibility because there was not much of a AUM associated with the fund. But the big problem came when the stock market recovered rapidly from the 2008 crash after the Manmohan Singh government was re-elected in 2009. And after that, there was a huge influx of AUM into HDFC Top 200 and HDFC Equity. And because of that, the portfolio churn, the portfolio turnover ratio of both these funds rapidly reduced. Prashant Jain had to stick to a large capish kind of portfolio. The number of stocks in the fund increased and so on. And that was kind of a little bit, I should say, stifling in terms of what returns were possible from this fund and so on. But even after that, he did manage to beat the index to some extent. It is only from the late 2017 or so when there was a kind of an imbalance in the stock market that I keep talking about, where the Nifty and the Sensex were driven by a few stocks upward, the other indices, other segments of the market went down. It is only then the underperformance became very dramatic, as we shall see below. Alright, so there is a very interesting quote by Prashant Jain about how they managed to invest in the early 90s. Please recognize, when he started in 1991, I was in my 11th standard. So it's not, he is not somebody to trifle with. You can't simply say, oh, he's a has-been. No, I don't think so. I think he's a very, very smart investor. He has done, he's probably the most experienced investor, fund manager in the country, and you can't one of the most experienced, and you can't simply say he's no longer capable of outperforming the index. It's not. We must treat his achievements with respect. So this is the since inception performance of the fund with respect to Sensex. You can't get an index. The fund is so old that you can't get BSE 200 TRA data up to from 1996, at least publicly available. So that's extraordinary performance, isn't it? That's extraordinary outperformance. But this was the kind of situation for for an investor who had who invested just before the 2008 crash or just afterwards. So it's not so bad for somebody who started after the 2008 crash. The situation was more or less the same, and the only in the last 10 years or so the situation has been this. Incidentally, these are all charts from a new Excel tool. I've been building a normalized plotting tool. You can just give any date, last 2 years, last 3 years, and then the graph will be normalized with respect to that date. I'm building that tool. I will release it in the next few days. I wanted it just for this kind of comparisons. If you look at the rolling returns, this is over 7 years, and you can see the outperformance here. The fund had been a brilliant outperformer, and then you can see it gradually, the gap between the yellow line, which is the fund, and the brown line, which is BSE Sensex, reducing, and it had its difficulties. But the last time it bet the index was somewhere in mid 2017 or so, but then it fell down. But it seems to have made a recovery, like I'll show you before. I'll show you in the SIP chart. What am I saying? And this is the 10-year rolling returns data. Again, you can see the gap drop, and after early 2018, it has been the outperformance has not been there. More dramatic in the 15-year chart, 15-year rolling returns. You can see that drop rapidly down, but it's still barely been able to manage in terms of 15-year returns. Of course, always this fund, you can't compare every performance every 3 years, 4 years. At least after the 2009 influx in the AUM, this fund has not been a kind of a short-term performer, but it has managed in the long term. But again, not much as it's seen above. This is the SIP performance. So I just said the fund had recovered a bit. So you can see here the 2-year, 3-year SIP is negative, last 2 year, 3 year. But then the fund has bounced back in the, if you look at just the last 1 year SIP. Of course, it's still lower than BSE Sensex, but then the argument is that, look, any fund which is not invested in the top few stocks of the BSE Sensex is going to underperform. That's something that's a caveat you have to keep in mind. And you can't say, no, I'm going to switch over to Sensex because of this reason. Don't do that. That can be dangerous. Switch over, become an index investor for the right reasons. Don't do it because of this recent outperformance that may not last, at least explicitly. That's what I mean. So you can see that the fund has not been able to beat the Sensex for the last 8 years, and what is this, 9, 10, I forgot the 9, 10, 11, 12, 13, 14, my god, last 14 year SIPs returns from this fund has been lower than that of the Sensex, and that's a big problem. Of course, these last 14-year SIPs have been measured with respect to the trailing, that is the last business date, which, like I talked about in the SIP video, a lump sum or SIP, if the final, however long you've been doing the SIP, the returns depend on the final movement of the index, whether the index has moved up or moved down when you measure the return. So that is what you're seeing here. That caveat also must be kept in mind. The other issue is that in the olden, I think 2007, 2006 there was an entry load instead of a trail commission, if I'm not wrong, and that entry load was removed by SEBI, and then you had the trail model and so on. Then the direct plans were introduced. Those things have not been taken into account. That is, the entry load is not being factored in these returns. These are returns of the fund manager, not the investor. At least, especially the older returns, you should keep in mind. I forgot when the entry load was removed and the trail loads came on. So for investors in active funds, whether it is HDFC top 100 or any fund, the only consideration is, will a fund manager be able to beat the market after this kind of imbalance is removed? I don't know how long it will take, but if it is removed, if and when it's removed, will they be able to beat? If you have that confidence with Prashant Jain, go ahead and stay invested in it, but it can be very, very, very frustrating. So otherwise, you should switch to index. Switch to index is very easy. But you have to be of the right mindset. I mean, you should understand that once you become an index investor, you can't say, oh, that fund is 5-star, my index fund is 3-star. That kind of problems, if you face, if you are suffering from a FOMO or that the grass is greener kind of syndromes, you can never be a successful index investor. My suggestion is, instead of investing in large cap funds, if you are worried about performance, switch over to hybrid funds, either aggressive hybrid or multi-asset or balanced advantage or dynamical asset allocation as per your risk appetite, as per the fund manager. You switch, you decide and switch. Then at least for the extra expense ratio that you are paying, at least you get the benefit of diversification between 2 or 3 asset classes, as the case may be. At least that much you can do, instead of worrying about staying invested in funds like this and worrying about performance. Bye bye.